All right, Chad, let's talk about 2023 industrial real estate outlook. I know you're an investor and an agent. I want to hear what your thoughts on where we're going with this. What's this
Yeah.
asset class going to look like?
Yeah, and good to talk to you again, Joe. Unfortunately, I don't think that there's a lot to be optimistic about in 2023. I think that there's a storm that started percolating in late 2022, and that's coming home to roost in 2023. But I also believe that anytime there's a storm, there's some people that are going to get affected more than others. And it'll largely come down to how prepared they are. For people that think that this might just be a light drizzle or it might just blow over, I think that they're continuing on with this analogy of the storm. I think they're going to get soaking wet, and I think that this is going
Right.
to be uncomfortable for them. But I also think that there's people that are weathering for the storm. They're taking steps to be prepared. And like yourself, I went through the Great Recession, and that was a tough time. That was a very difficult time, but things came through. That storm eventually cleared, and I think that it's going to be somewhat similar. I don't personally think it's going to be as severe as it was for the Great Recession. I
Right.
think that there is going to be a storm, and it's going to be ugly for some. But I think those who are prepared for this and are taking steps to weather this proverbial storm, I think they're going to come through it even stronger.
Now, do you think it's, when you say there's a storm coming, do you mean it's just stabilizing or do you think it's going to go down?
I think that there's no unless there's some policy change at the federal level where they either relax the pace that interest rates are going up or perhaps even drop interest rates. I see no foreseeable way that prices do not go down. And but you can compartmentalize that, because just as a storm affects different people different ways. But one example that I like to point to is the Amancio Ortega, the founder of Zara, very wealthy individual, one of the wealthiest guys in the world. He started buying a portfolio of property in the US last year, and I believe he bought a $900 million portfolio, all industrial tenants. I'm guessing that he fixed his interest rates for a period of time. The weighted average lease term on those leases was eight years and change, with large companies, Home Depot, Amazon, FedEx. So in my mind, if you're Amancio Ortega and you fixed your debt and you have these really good tenants as companies as tenants, and they're on for a long term, he probably doesn't care what happens in the short term with interest
Right.
rate fluctuations or economic turmoil. He's, for that portfolio anyways, he's not concerned what happens because he doesn't have to worry about anything for 8 years still.
Right.
Whereas somebody that has a vacant property right now that they might have bought at the absolute peak of the market, I don't see any way that the price is the same as it was when interest rates were 300 basis points cheaper. The interest rates are just making it more difficult to finance properties. It's a lot more expensive. These deals don't pencil the same way that they did last year. So in my mind, there's going to be some sector of the market where prices do go down in the short term, and I just don't see any way that storm coming in doesn't affect those vacant properties.
Okay. Now, with your portfolio, did you go ahead and did you redo leases before this hit, or do you have the opportunity to redo leases, or are you thinking that you're going to have a struggle getting some new tenants in some of your properties?
We've actually been very good on our portfolio, and even when the pandemic came in 20 or March of 2020, we had a few tenants that panicked and asked for some rent relief, and we granted it to them. We didn't give them any
Right.
free rent. We just deferred their rent, and subsequently they all caught back up. We I don't want to make it sound like we're reactionary, but I think it's too early to tell that you have to start making big steps. We're very responsive with all of our tenants, so we want to know if they're having any troubles. If they do, we always want to have that open door communication so that they can let us know and we can strategize on how we can keep them solvent and keep them as tenants in the building. Right now, we're not seeing this on the tenant level. I'm more seeing it on asset value levels where it's just more difficult to finance. If anything, I think that there's still going to be as much lease activity, perhaps even a bump in lease activity, because all the companies, and it's popular in industrial, unlike office where the vast majority of tenants lease their space. In industrial, a lot of companies actually want to own their own properties.
Yeah.
and in this rising interest rate environment, these companies are now shifting that mindset to saying now is just not the time to buy. Let's lease, let's push this decision off for a while. So I'm seeing more interest and more activity on the leasing side than on the purchase side. I think sales is going to be tough in 2023. That bid ask between what buyers want to pay and what sellers
Yeah.
want to get. There's always that spread, and I mean, you and I both know that's one of the most difficult things getting a deal done is
Yeah.
trying to bridge that gap in expectations. That opening right now is as big as I've ever seen it. Sellers still want to have like that peak of the market pricing, buyers saying, well, we just can't afford it. Our interest rates are making it impossible to finance that now.
Mhm.
So I think it's going to be very difficult getting sales done. It'll be creative parties that have to come together, coming up with vendor financing or contracts where perhaps they don't close for the foreseeable future. So it's like a rent to own or a lease to own scenario. I think people are going to have to be very creative to get sales done, but that's going to change. Like that
Oh
will
yeah.
be in the next year or so. But as a result, I think leasing is still actually going to be appealing to a lot of companies. But I still don't see a lot of positivity for this next coming year.
Okay. Now I know that Amazon, you probably just heard they're going to do a bunch of layoffs. Do you think is that going to be how is their portfolio looking? I know that they had stopped doing some development. I know that they were going to sublease out some of their spaces. What are they up to? That's
Yeah,
kind of a leading indicator, isn't it?
oh,
What retail's
I
doing
think
and
so.
industrial.
Yeah, I mean they just announced 18,000 employees that they're laying off, which is a staggering number to me. Like you think what one individual is capable of doing for a company working 40 hours a week, what one person's capable of doing. I mean, one person can really have a huge fingerprint on a company, and think 18,000 is just crazy how many people were
Yeah.
working in tech. And Amazon would I think that they would admit or acknowledge. They always keep their cards pretty close to their chest, but I think that they would acknowledge that they just overbuilt during this run up of the pandemic, where everybody was moving towards shopping online. Especially in the early days, a lot of stores were closed, so you couldn't even shop at those stores. So there's no choice but to go to e-commerce, and I think Amazon just overbuilt. They overhired. They saw this as being a longer tail than perhaps that it's showing to be. And e-commerce, I think Amazon is the barometer for e-commerce as a whole. If Amazon's starting to slow down and they're the dominant force in that, I have to think that other companies are seeing that trail off
Oh yeah.
in e-commerce growth as well. So I do think that that's representative of the fact that in a lot of markets there was Dallas is a good example. There's 70 million square feet worth of development going on in Dallas last year. That's 70 million square feet. That's an industrial market of a mid-sized town, and
Yeah.
Dallas was adding that last year. So it wasn't just Amazon. All companies, all developers, everyone was seeing this as an opportunity to add inventory, and there'd be this endless demand from companies that need to lease a space. And I think as we're figuring out right now is that even e-commerce, as it starts eating market share away from the traditional retailers, it can only grow at that pace for so long.
Yeah.
And couple that with just some general economic pullback as we're starting to see. I think that Amazon's doing the right thing. They realized that they had overbuilt, so they decided they're going to suspend some of their projects, and then they're laying off employees, which is unfortunate for 18,000 people. But it's not just Amazon. There's tech companies all over right now, and other industries that are laying off people.
Yeah.
And I think what we need to remind ourselves is that the federal banks are engineering this. Like that is their intent with raising interest rates, is that they're
Sure.
saying the economy is way too hot. We can't handle these inflationary numbers that are in the 7-8% range. So we've got to get this problem under control. We're going to raise interest rates. And that's the impact that they're hoping to have, is a general pullback on the entire market. So it's anyone that thinks 2023 is going to be rosy, it has to be looking at different tea leaves than I happen to be looking at. Because I'm a very positive person. Joe, you and I've talked a
Oh, I
lot.
know you are. We've done
I,
several videos.
Absolutely. I love being positive, but I don't want to be that blind optimist that refuses to look at signals that are clear signals that are coming at the market. So kind of my overall take on this is storms coming in. It's going to impact people that aren't prepared or that don't acknowledge that the storm's coming in. But storms are temporary in the grand scheme of things. I don't mean
Sure.
temporary as it's going to be like a 1 day storm. I think 2023 is going to have rain clouds over it for the majority of the year.
Yeah, and like you said, we've been through it before. Now you straddle the border between Canada and the U.S. Are you seeing the same thing in Canada as well?
Yeah, it's funny actually how all the central banks, and this is all over the world.
Mm-hmm.
I don't think anybody could have predicted this coming. Is that all governments printed money over the last 3 years? They printed an unprecedented amount of money, and
Yeah,
then all their central banks said, "Well, we don't think inflation is here to stay."
yeah, it's
Jerome Powell,
transitory.
yeah,
Yeah,
Jerome Powell's famous words, he said it was transitory.
yeah,
The fact that the people that are in charge of this, that are involved in printing all this money, didn't see inflation coming is concerning. But every country all over the world is facing the same problem: is that we have troublesome inflation. It's above that 2% theoretical benchmark that the feds want to keep it at. That's everywhere's experiencing inflation higher than that, and now we're all faced with no choice but to raise interest rates to try and bring inflation down. So
yeah,
it's that they're pulling that lever of interest rates, and my concern is that they've demonstrated that they either have no idea what they're doing, or that there's some underlying narrative that they're towing the line for politics or for whatever reason. Those are the only two conclusions I can reach. They either have no idea what they're doing, that they didn't see inflation coming after printing all that money, or they have to, there's an agenda under the scenes which we just aren't privy to. And if they do keep raising those interest rates to try and get that inflation under control, I think that you're trying to manipulate one side of the lever, which has different timelines than the corresponding other side of the lever. So I think that they'll raise interest rates too high. And by the time the market reacts, because there's a lot of companies, people that have floating debt, or they might not have a
hmm
mortgage coming up for renewal until next year, or they're not
yep,
deciding to move until next year, they're not going to really feel this pain. And just as an interesting aside, interest rates have actually increased at the highest pace in 4 decades.
yeah,
So it's still below what like some of those higher rates would have been years ago, but it's risen at the fastest pace in 40 years. So the for a homeowner, let's just use them as an example, who doesn't have a mortgage coming up until next year, whether the interest rates are 3% or 6%, it might not affect them until they actually have to renew that mortgage, or they decide they want to sell and they've got to get a new mortgage. Whatever the circumstances is, you can take that across all the homeowners, you can take that across all the companies, everybody that's carrying either floating debt or has a mortgage coming up next year. That's when the real pain is going to come. And it can be a homeowner that sees their payments go up $500, $1,000 a month. It can be a company that if they have their mortgage coming up for renewal, maybe they've got an extra $5,000, $10,000 a month now that their payments have gone on. Where's that money going to come from?
yeah,
Well, it's likely going to have to come in sacrifices in other areas. So either households have to pare back their spending in other areas, they have to go into more debt to fund their existing debt. Companies might have to do more layoffs. Companies might have to stop spending in other areas.
sure,
That's
sure.
where that's what really keeps me up at night, is that we haven't even seen the impact yet of these interest rates going up. But I suspect those chickens are coming home to roost sometime this year.
Yeah, it's going to start soon. Now, what level of on industrial do you think who's going to feel the most pain? Mom and pops, institutional, probably mom and pops, right?
Yeah, I don't think the institutional is going to
They're not
be.
going to feel it too bad.
I don't think so.
Cheaper
They've
debt.
operated so well for so long. They've got long-term leases. They typically attract much higher credit profiles, longer average lease terms. They've fixed their debt. Where I do think that not even the mom and pops as a blanket, but the mom and pops that are stubborn are probably the ones that are going to be most at risk. And that's someone saying, well, there's not a storm coming, so I'm just going to stay outside and maybe I'll bring an umbrella just in case. But they're not actually prepared for this. I
Yeah,
think it's
yeah,
the mom and pop that maybe has a lease coming up early in the year. Maybe they have to refinance their mortgage, or maybe because not everybody's on a 30-year fixed mortgage.
Right.
A lot of owners will do a 5-year fixed mortgage, and then they have to renew them every
Mhm.
5 years. Those are the ones where I'd be concerned about. Their payments are going to go up much higher than most people
Yeah,
anticipate. Like nobody's really grasped how much interest rates have gone up and what that means to their mortgage when they renew. And if they
absolutely.
lose a tenant, now you're double whammy. You just lost all your revenue and your expenses are higher. So like that's a pretty grim outlook for people that are in those positions.
Yeah, don't you think that, when we have these situations, there's always an opportunity for an investor. And don't you think most of the opportunity is going to lie in those people that have done a 5-year loan, and now they have to refi, and the payment they're going to get, it's going to be a tough one. Don't you think that's going to be probably the best place to be focused on if you're an investor?
I think that there's going to be a lot of opportunities for prudent investors that can mitigate risk much more than, call it, a mom and pop or a small investor
Yeah.
that has one property and they rely on that property to support their lifestyle, as opposed to
Mhm.
an investor that just wants to make a return. The people that are over leveraged, I think that that's where there's going to be opportunities to offer creative solutions to help them get out of their problem.
Yeah.
And I'm still a buyer myself. We just closed on a property in mid-December, so a few weeks ago, for $6.5 million, and we were able to get it at a pretty sizable discount for what we would have paid for that a year ago. So I'm a big believer that if you're an investor, you need to find a way to invest in good times and bad times. And it's almost like dollar cost averaging for like the real estate sector. Is you want to be aware of these trends, and they're important, because that can happen this year that affects one investor has a potential to affect all of us as investors. So
Mhm.
I'm just a big believer that you always want to make the best decision you can with the information you have available. Right now, the information that's coming in suggests to me that it's much more expensive to fund debt right now. That's just the reality. So you've
Sure.
got to look at anything you're buying with much more critically, more of a sensitivity analysis in there for like what that worst case scenario really could look like. But I'm also a believer that in the long term, you can make a really, really good in investment decisions if you have that long-term outlook, as opposed to someone that's perhaps trying to flip property or make a quick buck and sell a property within a year or 2 years. I personally look, every property that I look to buy, I think that I could hold it forever, and maybe it gets passed down to future generations.
Sure.
So in the lens of that context, yes, there could be a storm coming, but I also think that the storm will pass. And provided you can get through that storm, there could be some phenomenal deals coming up in the
Yeah,
next year.
we have clients, our agents have clients that are just waiting. They've got
Yep.
dry powder. They're waiting for these opportunities, and they're not going to jump at everything. They're going to jump at the ones that work best for them. And I think it's every investor, don't be too anxious. Find the right deal that's good for you. Find the great tenant, not an iffy tenant. I was just talking to one of our agents, and he put this a tenant in 6 months ago, a woodworking guy, makes beautiful furniture. Business was booming. Got him into he doubled their space requirement. And they've been there 6 months. They haven't paid rent for 4 months now.
Oof.
Yeah. And so we're going to have a call with them this afternoon. And, they have pretty strong financials. We'll try and work something out with them, but you've got to really qualify these tenants out. I wasn't, I didn't think that they should go so big on their new space, but they really want it, and they thought they could bring in new business, and they've not been through a downturn before. And so, and they were doing this high end furniture, custom furniture, and I don't know. We'll have to see. They got a bunch of inventory too, so we're going to sit down and have a call with them, because you got to find the right tenants.
Yeah, and that's a really good point. Is a lot of people have not been through a recession, and I wouldn't count 2020 as even though technically it
Yeah.
could have been considered a recession, as 2 consecutive quarters of negative GDP growth, but nobody's been through a longer one, because that was very quick. That whatever happened in 2020, whatever we want to call that or refer to it going forward, that was a blip. When you go back to 2008, 2009, that was a painful recession, but that was 15 years ago, which is crazy to think, actually. And the kind of dates us on that, but that was 15 years ago. So everybody's been riding this pretty strong bull market, and like every real estate cycle and every economic cycle, there's the peaks and there's the valleys, and unfortunately, I think we're heading into a valley.
Yeah, I don't know. We say unfortunately, right? But you as an investor are ready for it. You're looking for the opportunity. Now, you as a broker, like, yeah, deals are going to slow down. But as an investor, I just think it's going to be an opportunity. And when you do find the opportunity, again, you just got to find the right tenant to fill that space.
Well, and that's a great point too, Joe, is that as a broker, I do think it's going to be a more challenging year. And I think really milking this storm analogy, I think that brokers are really going to need to be prepared for that, because this is going to be a different year. It's going to be much more challenging. I don't think that there's going to be as much deal volume. I think it's going to be harder doing deals, but there's still opportunities for brokers that want to provide solutions, be creative with their clients, help them solve problems, because clients are going to have problems that they haven't had before. And the brokers that will come through this are the ones that are helping their clients solve the problems that they hadn't had before, because 15 years was the last severe recession. There's a lot of companies that haven't been through this. So brokers that are sensitive to that and are responsive and are doing their best to help their clients navigate this water, just as we're trying to navigate it ourselves, I think will do very well, and they'll really solidify those relationships, and those clients will be loyal to them for life. So this is an opportunity for brokers that want to really put their head down, really work, not complain, not think that the sky is falling and we should just take the year off and mope and be sad about it. I think it's the opposite. I think, how can we help people now? Like, what can we really do to solve problems, be creative, offer something that the competition isn't doing? And those are the brokers that I think will come out of this so much stronger.
Yeah, I think a newer broker, if you have got a tenant that's struggling, you need to get an experienced broker that's been through this before. And, prime example is what I was telling you about. This client has a ton of inventory sitting there, hundreds of thousands of dollars worth of inventory. Sell that inventory, close that storage unit down, and just custom it, custom make it for the next year. So you don't have to have the lease for he's got a huge storage space that he's paying a lot of money for. Put that toward your rent where your showroom is at and all that, and then custom make it with a little extended timeline, because if you've got that kind of money, you can catch up on rent next week. He's just got to get this furniture sold. Inventory is a killer. It's cash sitting on the shelves. And so get an experienced broker to come along with you and really look at how they can help your clients. Or if you know how, get out and help your clients. So, but all right. Well, Chad, thank you very much for this.
Oh,
appreciate you taking the time.
Always great chatting with you.
Yeah, it's always fun to have you on. Matter of fact, I will go in and find some of our other videos we've done. I'll put them below on this link, and then I'll put your contact information down below so people can reach out to you if they're looking for some industrial real estate to invest with you or to broker.
Awesome. Much appreciated. Always a pleasure to talk with you, Joe.
You bet. And for those of you watching, make sure you give us a like. And if you haven't done so, make sure you subscribe and check out our other videos on the channel.